Hey, hello, folks. Welcome to Pro Trader Strategies. My name is Eric Wilkinson, and this is Spotting the Trade. I'm going to get you folks what you need to know before you roll, and that's going to be talking about the economic data, how that impacts the overall markets with a little market analysis. Finally, round that off with a little geopolitical fodder, and then talk about some strategies we could implement into our portfolio based on those assumptions we come up with in this market analysis. All right, so we start off with the economic data. What's today? It's Unemployment Friday, folks. First Friday of the month. That's when we get the unemployment number. We get ADP and all these other weekly jobless claims and stuff like that. But the one we're looking forward to is today's number. And we saw ADP come off a little bit yesterday? And that would have led us to believe we were going to have a little bit of a miss here on today's number. Well, surprising to the upside, 390,000 hires coming out of the non-farm payroll change, expected to be 325. Now, it is one of the first times we've come off of that 400 number or that 400 handle, but still very close. As a matter of fact, I was expecting this to be in the 200 handle. So a little bit of a surprise to the upside. I kind of want to see a little bit of weakness here in the job markets because I don't want the Fed to keep raising rates and driving rates higher. So a little bit of a beat there, but we did see the unemployment rate uptick to 3.6%. Actually, it was in line at 3.6%. It was expected to come off a little bit, but we stayed in line with that number. And then finally, we got the hourly average earnings, and that came in at 0.3%, which was in line with last month. So while we're seeing some or feeling wage inflation, it seems like, and not really showing up there in the number. We also got some service PMI numbers from across the pond. These are their final numbers off of the flash estimate. No real revisions there. Everything pretty much in line. Above 50 is expansion in the economy. We saw that across the board. Keep in mind today is a holiday in Great Britain and the Queen's birthday or something. I think 70th birthday they're celebrating. So, you could see a little bit lighter than normal volumes based off of that. But I think afternoon, right after 11 o'clock today, I'd be a little bit hesitant on trades. I think we're going to see volume start to lighten up a little bit. You could see an upside move here. But with that said, I would not necessarily trust this upside move. I think that the bottom is pretty much in, but I do believe that we're going to try and build out a bit of a head and shoulders pattern that I talked about yesterday in these market commentaries or in the spotting the trade videos here today. One thing I wanted to show you is my screen. There we go. All right, let's get onto the screen. All right, crude oil continuing to try to climb higher here. We're looking at 120 in crude oil. And what does that mean with the gasoline prices? They're going to continue to get a higher fight, folks, unless we start opening up some wells here. We've got the bonds coming off. That's not surprising, especially I would continue to consider downside risk here in the bonds. Why? Because we just saw that number beat the street. Most analysts were calling that we were going to miss on that number to the downside, meaning we've all been a little bit worried. You've even heard me talking about some of these economic data points are starting to show some weakness here. And we're even starting to see some folks start to lay off and not hire. All of that stuff being talked about with some major corporations, at least here in Arizona or out west. So I would expect that to be something that is overarching. Keep in mind, job numbers are usually one of the last lagging indicators, if you will. PMI is going to be telling us that the manufacturing sector is slowing down much further or much more in advance of the employment numbers. The employment numbers are reactionary. If you're a company, your hiring and firing is very reactionary. These PMI numbers looking forward, when you're purchasing, you're making a bit more of a educated decision there on the future expectations of the economy. When you're hiring and firing, that usually means I'm in an immediate need right here. All right. And very reactive. That bonds looking like they're starting to roll over here. Again, talking about covered calls, lower that overall cost basis in your portfolio because your price is what's showing up in that portfolio value. As interest rates rise, those prices are going to go down. You can't chase yield. I've done videos on it time and time again, showing how you can't chase yield. Sell the bonds in your portfolio and go out, buy bonds that are giving you a higher coupon. That doesn't work, folks. Please don't try to do that. If you have those bonds in your portfolio, I would leave them at this point and do covered calls, lower overall cost basis. Get your coupon that way. All right, gold futures. We are testing the value area high. While that is a big deal, I think that we really need to have this market move a little bit higher. I think inflation is still a key factor here going forward. If we are not going to produce any more oil, that is going to continue to drive prices higher across the board. It doesn't matter what it is. I mean, prices for everything, folks, are going higher, especially because even if somebody has to move rock, all right, for landscaping, or if they have to move concrete, that machine uses a lot of gas. So while that's using a lot of gas, that means those prices for those goods and services are going through the roof as well. So I'd like to see that come off a little bit to allow a little bit of freeing up of the economy, because we will start spending our money in different ways. All right, so I threw in a couple lines here for this. I was talking about yesterday, the neck pattern here. We do need to have a little bit of a breakdown, probably around, like I talked about, 12,250. Let's call it 12,000 even would be an area of interest for this market to come back down, create that other shoulder like we talked about. This is one shoulder, the head, and we've come up, try to create another shoulder. So we've created the neckline there. Now we could break through that, and this pattern doesn't mean anything, but other than that, we found a bottom. We're just looking for different types of patterns here. You know, some people could say that's a cup and handle. I think the handle should be on the back side of this, but still starting to set up like a nice little bottoming pattern here. Dow Jones Industrial Average, here we go. We've got our same neckline, you know, trying to build out. We'd like to see this drop just a little bit more to build out a shoulder. That's kind of an ugly shoulder, but the neckline's still intact, driving it higher into the value area. So I'm looking as this bottom here is at least the near-term bottom. We might have a little bit of a pullback here in the next week here, create that other shoulder. That would be a very solid bottom for a market, because that means it came down, tested, broke through, and the bears came back again for the third time through their thinking, and then the bulls come in and break that, get those bears on their heels, and that's what causes that incremental move higher there. With that said, it creates a very strong bottom when that happens. This is a pretty solid bottom. You can see all of the battles back and forth here at this area. We did go down and test right on that Fibonacci that we were talking about. So that support level is key. I think would hold it again. If even we went down there, that would be like a tweezer bottom. We can check out the E-mini S&P's overnight inventory is a little bit bearish. I think that we're going to get some upside off of the bell from the unemployment number being so good. I think we'll get a little bit of upside, and then folks are going to kind of say, we need to have a little bit of a tantrum here, because if the unemployment numbers continue to come in as strong as they are, there is no way the Fed is going to even consider slowing down on the interest rate hikes. Okay, interest rate hikes to slow down the economy. Well, we're trying to slow down an economy that is really driven by inflation at this point. So we're going to have to keep an eye on those levers and pulleys, see how we work through all of this. I think if we seriously, folks, just opened up some wells here in the United States, that would cause shipping prices to come down, and that helps ebb inflation. All right, just my 2 cents. Have a great weekend. And if you can't take that, take it easy. Don't forget to smash the like button for me, folks.